Welcome to the Deep Dive. If you're tuning in, you're probably thinking about your investments, especially with the economy feeling a bit shaky right now.
Yeah, things are definitely shifting.
And that's exactly what we're digging into today. These new tariffs and what they might mean for, your financial decisions.
Making smart choices with your money right now really means getting a handle on the big forces at play. And these tariffs, they're a pretty significant new factor.
Definitely.
So we're here to try and cut through some of that noise, offer a bit of clarity for you.
And to help us do that, we're looking closely at a recent memo from Howard Marks. He's from Oak Tree Capital Management.
A very well-respected voice.
Absolutely. The memo is dated April 9th, 2025, and it's called Nobody Knows Yet Again. And Marks, he's got decades of experience, right?
Yeah.
He steered through the 2008 crisis, the early days of the pandemic.
He really has seen a lot. So when someone like him talks about uncertainty, yeah, you pay attention.
Exactly. His message during those turbulent times is just so valuable for anyone trying to protect and, grow their capital.
It's that long-term perspective. He's seen these cycles.
So our mission today really is to pull out the key insights from this memo. The goal is to help you understand how these tariffs could ripple through the economy and, crucially, what that might suggest for your own investment strategy.
Okay, so let's dive in. The core message, as you said, is uncertainty.
Right. That title says it all. Nobody knows, yet again.
Yeah, Marx is pretty blunt about it. He argues strongly that predicting the future, especially like the full impact of these tariffs, well, nobody can really do that with any certainty.
Mm-hmm.
And he ties it back to his older memos with the same title from the financial crisis, from the pandemic start. It shows this kind of major uncertainty isn't new. It sort of crops up again and again in investing.
Which makes sense. We haven't really had a big modern trade conflict quite like this before, have we?
No, it feels like relatively uncharted territory.
And Marx has this quote, which feels really central for investors right now. There's absolutely no place for certainty in the world of investing, and that's particularly true at turning points and during upheavals.
That's such a fundamental point for anyone managing money. The lack of clear historical parallels, plus just how unpredictable governments and economies might react, it creates this unique fog.
Yeah.
But what's interesting is how Marx talks about the danger of just freezing up because of the uncertainty. Doing nothing is also a decision, right?
That's a really good point for listeners. It's so tempting to just sit on the sidelines and wait.
Right. But he actually mentions a book title, something like, "When the time comes to buy, you won't want to."
Yeah. I know that feeling.
It suggests that the very fear driving markets down might actually be creating opportunity, bargains, potentially.
If you could stomach the risk, yeah. Because pessimism is usually sky high at that point.
Precisely. And Marx also really stresses how fluid things are right now. He warns absolutely everything is subject to change.
So stay nimble. Don't get locked into one view.
Exactly. Constant awareness, maybe adjustments, are going to be key for investors navigating this.
Okay, so uncertainty is the big theme. Let's shift gears a bit and look at the reasons behind the tariffs, at least as Marx lays them out. What are the stated goals?
Well, he lists several objectives that are being put forward, things like boosting U.S. manufacturing,
Right.
encouraging exports, discouraging imports, trying to shrink that trade deficit,
Okay.
also securing supply chains, bringing production back home, onshoring, and then deterring what they call unfair trade practices, trying to force negotiations, and maybe even raising some revenue for the government.
And, Marx notes that if you look at each of those goals in isolation, they sound pretty good, right?
Yeah, who wouldn't want stronger U.S. manufacturing or fairer trade? The individual aims seem desirable.
Yeah.
But yeah, the real issue Marx dives into, and where all the investment uncertainty comes from, is those knock-on effects, the second and third order consequences.
The unintended stuff.
Exactly. That's what's so hard to predict. So, while the aims might sound good, the memo really suggests the consequences could be the bigger story, potentially outweighing the benefits for the economy and, for your investments.
Which brings us squarely to the potential downsides. And according to Marx, this is where it gets, complicated and potentially worrying for investors.
Yeah.
What negatives does he foresee?
He lays out a pretty significant list, actually. Retaliation is a big one, other countries hitting back with their own tariffs.
Makes sense.
Then there's the risk of price increases, rising inflation for consumers,
Okay.
a potential drop in demand if prices go up and people get nervous, the risk of recession, job losses, both here and globally,
Wow.
disruptions to supply chains, shortages maybe, And even, he suggests, a really big shift in the whole global economic order we've gotten used to.
That's a lot for investors to think about. Let's unpack the price increases bit. How does he see tariffs hitting our wallets?
He explains it pretty clearly. Tariffs are basically taxes on imports. And those taxes, they're very likely just passed straight through to the consumer.
So we end up paying more.
We end up paying more. And it's not just for stuff made overseas. It also hits U.S.-made goods if they use imported parts or materials in their production.
Okay. So the impact could be pretty wide.
Potentially, yes. He even brings in some history here, looking at consumer goods prices.
Oh, yeah. What did he find?
He points out that between 1995 and 2020, the prices for consumer durables, things like cars, appliances, electronics, actually went down in real terms, even while other prices went up a bit.
Huh.
And a huge chunk of those durables were imported. So he asks this really crucial question for investors thinking about inflation now. What would inflation have been like back then without all those cheap imports?
That really puts it in perspective, doesn't it, if tariffs reverse that trend?
Exactly. It's a major factor when you're assessing the potential for these new tariffs to push inflation higher.
And what about the idea of bringing manufacturing back, the whole onshoring thing? Mark sounds a bit doubtful about how easy that is.
Yeah, he raises some pretty big practical hurdles. First, do we even have enough factory capacity here in the U.S. right now to make everything we currently import? In many sectors, probably not.
So you need to build new factories.
Right, which takes a lot of time, a lot of money. And second, he asks, will companies actually make those huge long-term investments based on tariffs that, could just be changed or scrapped by the next administration?
Good point. Politics adds another layer of uncertainty. He mentions the Mexico-Canada tariff changes under Trump, right?
He does, exactly. That shows how policies can shift. Third, is there even a skilled workforce ready in the U.S. to do all that manufacturing work? And finally, he kind of goes back to the basics. Why did we start importing so much in the first place? Often it was just cheaper, especially labor costs.
So he's not saying reshoring is impossible, but maybe tariffs aren't the magic wand.
Pretty much. He seems to argue the current tariff approach might be too blunt, leading to higher costs without actually guaranteeing long-term success for the economy or, for your investments.
So even if tariffs make U.S. goods relatively cheaper compared to the now taxed imports, the overall price tag for consumers is likely still higher than before.
That's the nub of it. A real challenge for consumers and a key thing for investors watching consumer spending. Marks suggests, look, if wages don't keep up with these higher prices, people's purchasing power drops. Standard of living goes down.
Okay.
But if wages do chase prices higher, then you risk getting stuck in one of those nasty inflationary spirals.
Yeah, a tough balancing act. Marks also mentions company profits, doesn't he? And why investors should watch profit margins.
Yes, he brings up an economist, Conrad de Quadros, who sees corporate profit margins as a really important warning sign for recessions.
How so?
Well, tariffs can squeeze those margins, right? Either companies absorb the extra cost or they raise prices and risk selling less.
Right.
And when profits get squeezed, what do companies often do? They cut costs, layoffs, reduce spending, and that can ripple outwards, potentially tipping the economy into a downturn, which would obviously hit investment portfolios.
He had that example too, the 2018 steel tariffs. How did that illustrate the complexity?
Right. So, yeah, there were reports that those tariffs saved some jobs in the U.S. steel industry itself.
Okay.
But Marks points out that far more jobs were probably lost in industries that use steel car makers, construction, appliance manufacturers, etc., because their input costs went up.
I see. So it's not just about the one industry.
Exactly. It shows how these things aren't simple. They have knock-on effects across the whole economy, something investors in lots of different sectors need to keep in mind.
Okay, let's broaden the view again. What about the international side of things? Marx talks about the role global trade has played historically.
Yeah, he really emphasizes how positive global trade has generally been, especially since World War II. It's contributed to peace, prosperity, largely through this idea of comparative advantage.
Explain that quickly.
Sure. It's basically, if Italy is great at making pasta and Switzerland is great at making watches, it makes sense for them to specialize and trade with each other. Everyone gets better stuff, likely cheaper. Trade barriers, like tariffs, kind of force countries to do things they aren't as good or efficient at. That means higher costs, maybe lower quality. It ultimately hurts consumers and can slow down growth everywhere.
And the U.S. has actually benefited hugely from this system, even with some job losses here and there.
Massively. Marks acknowledges, yes, some U.S. industries faced tough competition, jobs were lost, but he argues the vast majority of Americans have seen their standard of living improve significantly because they have access to all sorts of affordable goods from around the world.
That's why so much stuff says made in somewhere else.
Exactly.
He also mentions America's role after WWII, that sort of generosity, and how these new tariffs might change global relationships.
Yeah, he talks about things like the Marshall Plan, aid to Japan. He calls it enlightened self-interest. Meaning, yes, it was generous, but it also helped create stable democracies, reliable trading partners, and huge markets for American products. It benefited the U.S. too, long term.
Okay. So now he outlines potential downsides to this new, more confrontational tariff approach. It could antagonize allies. It might push countries towards closer ties with China or Russia. And importantly for finance, it could mean less foreign appetite for investing in the U.S., including buying U.S. Treasury bonds.
And that Treasury bond point is pretty critical for our financial system stability, isn't it?
It really is. Marx uses this analogy of the U.S. having a golden credit card. We can run big deficits, partly because the world trusts the U.S. economy and the dollar, and they're willing to lend us money by buying treasuries.
Okay.
If that confidence starts to wobble because of tariffs or other issues, maybe fewer countries buy our debt. That could force our interest rates higher, make the national debt harder to manage, and increase borrowing costs for everyone in the economy.
A potentially serious consequence. Now, he did include a bit of history, didn't he? About Japan and cars in the 80s. What was the takeaway there? Right, the Japan auto industry example. It basically showed that even when the U.S. lost dominance in one major industry, cars, in that case, the overall economy didn't collapse.
It adapted.
It adapted. It shifted focus to other areas, often higher tech, higher margin, things like software, jet engines, you name it. It raises that fundamental question for investors. Is trying to, fight against these natural global economic shifts using tariffs really the best long-term play?
Interesting point. So putting it all together, what's Mark's bottom line? His overall assessment of these tariffs?
He's pretty critical. He basically calls the tariffs an own goal. You know, like in soccer where you accidentally score against your own team.
Ouch.
Yeah. He even draws a parallel to Brexit and the economic headwinds the UK has faced since then.
Okay.
Now, he does acknowledge there could be some long-term positives, maybe more U.S. manufacturing eventually, maybe fair trade deals, maybe some revenue for the government. But he really stresses that the costs like potential recession, higher inflation, seem much more immediate and potentially larger.
And the stock market reaction kind of reflects that uncertainty.
He points to that, yeah. The market drop suggests a pretty significant shift in how investors are viewing the economic outlook, though, of course, nobody knows if that market reaction is perfectly calibrated either. More uncertainty.
And what about the Federal Reserve? He mentioned they're in a tough spot.
A very tough spot. Normally, if you fear recession, you cut interest rates, right, to boost things.
Yeah.
But if you have inflation, especially inflation caused by tariffs, the usual playbook might say raise rates or at least hold them high.
So they're potentially being pulled in opposite directions.
Exactly. It's a really tricky situation for them, makes monetary policy very difficult, and just adds another layer of uncertainty for investors trying to figure out where rates might go.
Okay, so finally, what does this all mean for Oaktree itself, for their specific markets and how they're approaching things now?
Well, Marks notes that in the credit markets where they operate, all this fear has actually pushed up the yields, the potential returns, on certain types of debt. People want more compensation for taking risks.
Okay.
At the same time, the flight to safety has maybe pushed down yields on super safe things like treasuries. But overall, for the credit they focus on, they see potentially better returns available now.
Interesting.
They also think, some companies might run into financial trouble because of all this, which could create opportunities for their opportunistic debt funds to step in.
Kind of like finding value amidst the turmoil.
Exactly. He even echoes something he said back in 2008, that sometimes in these fearful environments, good assets get thrown out with the bad, creating potential bargains.
Right. So wrapping this up for our listeners, the big message from Howard Marks seems to be, buckle up. We're in a period of serious economic uncertainty, thanks to these tariffs.
Yeah, that's the headline.
And it really demands a careful, thoughtful, maybe adaptable approach to your investment decisions.
Absolutely. Marks keeps hammering that nobody knows point. Certainty is off the table. So for investors like you listening, the best you can do is make decisions based on the most logical reasoning you can muster, based on the potential consequences. even without feeling totally confident.
Understanding these potential effects, we've talked about inflation, recession risk, international relations, that's crucial for navigating what's ahead.
It really is. It helps you make more informed choices for your own portfolio.
And that kind of brings us back to you, our listener. Thinking about everything we've discussed, these potential shifts, Mark's warnings, historical examples, it makes you wonder, doesn't it? What overlooked areas, maybe what sectors or asset classes might actually hold unexpected opportunities? Or maybe hidden risks because of these tariffs.
Yeah, those second and third order effects he mentioned.
Exactly. Maybe something to really chew on as you think about your own investment strategy in the coming weeks and months. Thanks for taking this deep dive with us today.